Hello traders, welcome to FreeFX. This is video 139. I haven't made a video for a few days, and indeed my last video was on Thursday the 13th of October, which was CPI day, and indeed I haven't had a video since then because I was away on holiday. Sorry for not being in touch, and there's no camera today, but I'm going to try to run through a few things because it's been so long. So to start things, I would look at this first of all. It's the SPX, and we have the 4-hourly in front of us. Now, just a little premise. The last time I looked at things was on the 13th, and we had this open, and I was doing this pre-US Open, so I traded this live on that day. And you can see the big candle with a swing low down to a low of 3493. Today we are at 3793, so we're exactly 300 points between them. And if we measured that, just to make it really quick, we could sort of say roughly without any hesitation that this area here is where we're at. Okay. So low to high, we've got this area. Now, if you kind of look at it even just visually, you can see that the green line crosses it pretty much halfway, and so we're basically like ranging in this area. And if I extended that to here, you could say that we've been ranging for some time. We've kind of been ranging almost since the start of the month. Okay, we've had a swing high there. Here, if we just make this a bit more encompassing, let's take it from here then. So we are currently the same level as we were back then. Okay, I think I've done it right. Let's see. So and you can see that the reason for that is that the green line is indeed the same level that we had in our June low. The 16th of June is our swing low. And that swing low has become a bit of a sticking point since we entered this area on the 26th of September. We've kind of been playing around, trying to break below, above, below, above, back to it, above. So the only difference that's kind of happened recently is that we've had, on the 4-hour chart anyway, we've had high lows, so here and there, almost consecutive. And so we could say that that's kind of created a bit of a sense of expectation, whereas before it was kind of ranging up and down. So, but I think apart from that, we've had that surprising swing high on that CPI day, and there have been lots of kind of speculation or people trying to explain the reasons for that, and some of them make a lot of sense, like option puts being sold, and that creating this vacuum for price to jump up, and they're not sort of really achieving much. Then we've had sort of speculation through this sort of Wall Street Journal on Friday the 21st, saying that there might be a pivot or something because Tess Daly from the Fed might said something about not wanting the Fed to hike rates too aggressively, maybe thinking of tightening 2023. As in, restricting rate hikes. So, that created the jump. Some people said that was because the dollar was sold through FX intervention from the Ministry of Finance in Japan, trying to curb the USD JPY dollar yen exchange rate in the forex market, etc., etc. So a dollar fall equates to stocks going higher anyway. So, but this has sort of fizzled out, and to prove that, I'm going to, not to prove, but to sort of demonstrate that, I'm going to add yet more divergence in my proceedings, and I've done this a few times now. So we'll make it the same, and we will certainly want to do that, but we'll not extend this line. So let me just change that. Okay, so that's the sort of start of a divergence. We got price moving higher from this point, and then the CCI moving lower. So from the CPI point, we have moved this 300, but we've basically gone back to, let's call it a neutral level, which is the swing low from the 16th of June line. That level is at 3660 pretty much, and that's kind of where we're at now. So we kind of from there up 3660 to 3793, it's 133 points. Let's call it 130 points. So it's not such a big move when you think about it. I mean, it's really not a big move. We've had sort of bigger moves than that. And anyway, so the overall trend up to this point seemed to be a downtrend, and we've had another blip in that sense, but nothing seems to have materially changed. Indeed, the mood seems to be one of sort of acceptance that things are not as good as they could be, and we talked about a number of things before. So my last video 138, I was talking about the CPI, and before that I was talking about the SPX maybe dropping another 5%, and I sort of made comments relating to this particular level, the June low, and how low we could get from there, excuse the pun. One of my other levels, indeed, I'll need to go to the daily for that, but first I'll save this new chart layout, is that we have a pandemic low, or rather pre-pandemic high, which is now a low, and my sort of idea was that when we got to the this swing low CPI Tuesday or nearby, we weren't too far from this level, which seems to be fairly acceptable, and it's just under the 3400 level. It's 3391, so it's not that far really. And what would that mean psychologically, if you like, is that we've accepted that from the pre-pandemic high of February 2020 to the present day, essentially the Standard & Poor's 500 index is flat, has been gaining nothing. It sort of, if you take it as a net value in 2 years, it's not gained or lost anything, it stayed flat. So if we had a sort of monthly view, this might become more apparent, because you would see maybe that in a slightly more clarified form. Here we go. So there's the pre-pandemic sort of level high, and that's where we are now. So in the greater scheme of things, we've sort of swung low, swung high, and swung low. So had you sold off pre-pandemic and then stayed in cash, or put your money in other investments, or traded something else, and then come back to it when this got to the same level, you'd be wondering what had been going on, and that's often a case. But it's 2 years, so it's not a week. It's not the 2 months of the pandemic outbreak and thereafter, which is much more dramatic. So it's been a slow churn, and has been, obviously an uptick before that, and then a drop, etc. So I'm not saying it's not been worth it for some. It's just obviously demonstrates how it has been a fair retreat from the highs, and that causes some concern. While we're on the monthly, you can see that the Bollingers are kind of met price, and then we seem to have bounced off it. So if I were in a different mindset, I would be saying buy. I haven't quite got there. From the CCI point of view, we kind of gone below this level of the pandemic, where we had let me see, minus 118 more or less, and here we are at minus 141. So we've kind of gone lower than that. Indeed, we've reached lower than any of these. So that one and this 2016 low, we've reached lower than that on the CCI. And the one before that obviously was our beloved 2008 Great Financial Crisis, where we reached, as I said before, minus 267 more or less on the monthly. On the weekly, which I just skipped because I wanted to show you this, what's interesting on the weekly is that just like we've got the 21 WMA on the monthly, sort of about here, where we had the July-August rally, we are now roughly at the levels of the weekly supporting moving average, and that is the 200 period moving average on the weekly is basically at the bottom of this candle here, which was the 17th of October, so last week's. I don't have that because I've got too many indicators already for my free version of TradingView, but I can see it on my mobile app, so you have to trust me on that. It's kind of here, basically comes up to this point. So this is a crucial point. You can see we had this battle for 3 weeks trying to get sort of below that and not achieving that. Kind of similar to what happened in June. When we got to that June low, and that's our swing low, that green line, we sort of bounced off and we came back halfway, and then we got this basically ascending triangle. Now, ascending triangles, triangles, flags, or pennants tend to be continuation patterns, not always. But so we had this break out to the upside, went through the basis, the middle line of the Bollinger Bands, and then we ended up coming back lower. So it's almost like a fake out or a failed breakout and a continuation of the downtrend. We could be having a sort of similar thing where we had a sort of range bound condition with high wicks there, a breakout, and then we've got this moving average and basis, and we could sort of take a swing low to this level of the pre-pandemic high. I'm not saying that's definitely going to happen, but it's sort of how I'm seeing it. However, of course, I'm sort of putting the money on the table on this, so I take my sort of vow of honesty and say that I disclose an interest, shall we say. So of the CCI, what we get on the weekly is this rejection of the -200. I've talked about it before, how we were going to maybe push lower, that we had 2 rejections, and we seem to be heading lower, and we had a further rejection, and we've come off quite high compared to this peak back in May. So if you imagine this being a measure of a continuation of the downtrend, this denied it through the rally, and then we came back into the fold. So we'd have to kind of curb this before the zero line, although we've had this before, and it sort of worked a treat coming back down in April and May. So it might come all the way up to the neutral level and then continue lower. Just bear in mind that the moves here are not necessarily corresponding to price moves. They have their own sort of logic in a way, but as you can see here, this is kind of fairly overall fairly flat compared to this rise, which again should have been a cause for concern, but you know, it is a weekly chart. So having said that, we are going to, so we're looking at this and wondering, you know, we're coming to the close now of the US session. We have this sort of stall, if you like. I don't know what the COT would show us if we went to Barchart and had looked there, at their COT, what it would show us in terms of the S&P 500, but we could certainly have a quick look. But if you want to look for it yourselves, you need to go to barchart.com, futures, commitment of traders under the tab for S&P 500, which will be here. And there's one for VIX as well, but let's talk about this one. And clearly you can visualize with a sort of wider time frame. Let's say if we wanted to do, well, that's a 3-year there, but if we did just a year, let's say, we could certainly have a more detail on what the positioning is for this. So let's do a 1 year, and again, this is just the S&P futures. Now, the disaggregated data, as you can see, shows us that the leverage funds in blue have actually been dropping, while price has been sort of trying to rise. So this drop has been happening from about the 10th of April, kind of neutral and dropping as well through the past week in October. So we need to see what is reported this week. Well, that seems to be the case. And then we have a slight sort of overlap here of things. So we can see a slight kind of flattening of positioning amongst the asset manager and the dealer intermediary. So not a strong push per se, but if we wanted more detail again, we can go to a smaller time frame and see in 6 months what that looks like. Now there's a slight uptick, as you can see, and divergence maybe between the commercials and the leverage funds. But leverage funds are down, so that obviously means that we are down 413 point, etc. And that was quite a drop there. So it is important to keep an eye on these, just to kind of get a sense of where money is going. On a different note though, we have a week of events. So if you look at different calendars, now you can get, for example, John Kicklighter's Manic crisis calendar, which I recommend if you sort of subscribe to his mailing list. He's been doing this for years. You'll see a lot of events here, and the Manic crisis calendar obviously is filled with events there. So there it is for that was the one he made for the end of last week, and that was what we got. But there's a lot more stuff happening in the next few days. So let's go to the economic calendar here on MyFxBook. Now you can see that we have all the sort of high impact events coming up, starting from the current date. So Monday we have the Chinese data. So the interesting thing about this is the retail sales being down. So I think this does speak to a slowdown in the economy. We also have the GDP, much awaited year-on-year growth rate, supposedly being 3.9, so up from the consensus is much higher than the previous 0.4. But we don't know for sure if these are truthful figures. And we just had the Chinese Communist Party conference closing. You saw the scenes of the previous Chinese the president leaving or being escorted out. We think it's possibly it was a personal issue, not sure if health or, but he did seem to be surprised, so we wonder if, but certainly there seems to be a lot of focus on presenting this sort of united front of the party and Xi Jinping. So I'm not sure if there is a definite growth that we can say, but interestingly as well, we had some data from the US, the global services PMI, it's very important. That came out weaker than consensus and weaker than previous. So I'd say this is quite important to pay attention to. But obviously, price action goes where it wants to go. Tomorrow it doesn't say anything except this business climate, but actually what's happening tomorrow is that we've got Google's parent company, Alphabet, reporting its earnings, and the forecast is that it will be down 10% on a year-over-year basis for its earnings per share. And year-on-year revenue is forecast to be plus 8.5%. That's the kind of focus there. There are other sort of earnings as well, all expected to be with a plus sign, except Spotify on the minus there. But we have to see what that means in terms of the data. This is just an eagle-eye view. For the next few days, we have Thursday with Amazon and Apple as well. If we go back to our calendar here, we also have a few figures for the US. We've got new home sales. We've been seeing a lot of this, and certainly there's a problem in housing. A slowdown seems to be inevitable at the moment, with the Fed sort of killing demand with rate hikes being passed down to consumers, to home buyers, etc. And I'm not an expert. I'm just I read a lot, and that seems to be how this is playing out. Home sales again, clearly becoming more expensive. Learning from mistakes where mortgages became too cheap and bad credit was encouraged, and we had the great financial crisis, the house of cards. So that will not be allowed to be repeated. If we learned anything, it's housing bubbles. Thursday we've got, as I said, we've got Apple and Amazon, both expected to be doing okay in terms of earnings and price. You can see that here again. If you scroll down, it says that we have we've got Amazon to report revenue of plus 15% year on year, and earnings. Now, I say that everything is hunky-dory, but earnings are meant to be down, actually, minus 29% year on year. Because, obviously we've had a pandemic, and online sales may have received a lift from more people choosing to shop online. So that will be changed because of the circumstances having improved with physical shopping, etc. Apple, not on the other hand so much, but Apple is the expectation is earnings to be up 2.4 year on year, and revenue up 6.6. So not big numbers. I mean, if you look at the some of the calendar earnings, there are some energy companies. I think it was, I can't remember if it was Shell. Some energy companies, are doing pretty well. I think it was Shell. There was a company reporting a plus 126% increase in profit. So I mean, it's really quite staggering numbers compared to maybe some of these tech companies. Maybe really just have to wait and see as well what the impact of that would be, because we don't have a lot of stuff from the US until the we do have a lot of things, but we don't have anything as big as, I should say, the Federal Reserve rate decision, which will be happening on the 2nd of November. So we are the 24th now. We've got a few days of basically blackout, no comments to media, etc. In the middle of that, we also have two more things. One is the ECB rate decision, which doesn't seem to have a press conference afterwards, or maybe there is, but it's not meant to represent a high impact. However, the consensus is it's going to be a 2% or 200 basis points not 200 basis points, sorry. It's meant to get to 2%, and the previous was up to 1.25%. So that would make it a 75 basis points rate hike. So some people have been saying it's going to be 100 points, but unfortunately I don't have any way to assess that. Now, if you look at the Fed funds futures with the CME Market Watch, for example, we can assess that for the Federal Reserve rate hike, and we have this on tap. I heard rumors of 100%. It's 95%, which is pretty strong. So we seem to be expecting that, and that would take us to 375 points, or 3.75, and then if we take 3.75 and go to the next one, 14th December, so 375 up to 450, that would be 75 basis points, or 0.75%. Possibility for that would be 54.something%. So still the dominant one would be basically two rate hikes of the same amount, 75 basis points next week and 75 in December. So that would take us to 450, and then from 450 to 475 in February. So only 25 basis points. Now there's a long gap because of Christmas, and it's basically all of January plus the last half of January and the 1st of February. So it's it's not a super long wait, but certainly it at the end of the year and the start of the year, that's a pretty sensitive area. So I'm not sure how accurate this will be, that we're only going to see 25. A slowdown from 75 to 25 seems a bit sudden for a large institution, especially for the inflation to come down so fast that they can slow down to this degree. I'm not sure, but we'll have to see. Certainly it's going to be a difficult Christmas for a lot of people, so one should really watch what happens there. And for that reason, I think the GDP on release on the 27th, so that's Friday this week, for the US is going to be highly important, and the third quarter expected is 2.4, previous was 0.6. So for some reason, and there's an expectation of this actually rising quite a bit, I would sort of go to something like trading economics and see what that looks like in the greater scheme of things. So if I said US GDP and sort of looked for it there, so that's the historical data. Okay, so growth rate and data and forecast. Let's look, see what this looks like. Okay, so chart line. Okay, so we are basically that's still 22. This doesn't seem to be right. I think I'm going to go back. That doesn't really make sense to me. It's not what it says here. Let's go back to the historical one then. That's the historical data. 2022 has basically been so far has been equal by a few centimeters there. But no, seriously, it seems almost equal to 2021, but it's obviously less than, and we haven't finished the year yet, so we're still feeling the impact of intervention from the Federal Reserve. The 2020 obviously was the worst year there, almost on par with 2018. So we had a sort of bumper year in between, let's say. 2021, great. So ascending there, if I said line and then put it to maximum, what that shows is continuous growth. Now I have a problem with that, because really that makes it look like infinite growth is the end result here, and we should just sort of be looking at a country increasingly prosperous. But gross domestic product is basically just one metric. So if we look at, for example, GDP from services, actually from manufacturing, let's say, okay, for the States, and put it into a line chart, okay, that's what it looks like. If I put it to a 10-year, for example, it's a little bit choppier because we had the pandemic there. And if I put it to maximum, again, if I put it to maximum, this is not such a pretty picture. It's not just infinitely going up, although that's just from 2000 5 there. So as you can see, the top of 2008 in terms of manufacturing, we haven't really got to those levels until 2018 roughly. So, and then we've got things like real consumer spending, obviously down during the pandemic there. But if we had it as a maximum there, you can see the big swings. And if we did it as a line, that is the line, yes. We could see that we've had some kind of swings high and swing lows, but the main one is the pandemic kind of effect there. Again, if we look at things like mining, you might think about fossil fuels. I don't think that mining includes gold, but I couldn't be sure. There you go. You've got just one data there, so I'm not really sure how it's broken down. But anyway, so if we look at the chart on a line, and put it to maximum, what you can see is that we had from 2005 here an increase, and then from essentially the pandemic we've had just a big decrease. So mining has kind of taken a hit. We've heard of things like logging, really lumber, I think it was, taking a hit this year. So whether that's to do with transportation costs or what have you, I think that's an interesting metric as well. I saw a graph from markets and Mayhem and markets, and it said, I don't think I'll be able to find it, but it was here. I think you can find it. So it basically said that we have, it was a number of countries being analyzed. And it said that a lot of revenue, or rather sort of the strength of those countries in terms of the economic growth, comes from not agriculture, for example, manufacturing. It comes from essentially services. So if you think of services as, you know, anything like people working in bars and cafes, just to give an example there, but people driving delivery vans, people doing cleaning jobs, etc., etc., etc. So anything that isn't producing the prime materials, for example, like in agriculture, etc., or manufacturing. So that is an interesting metric. I don't, like I said, I'm not sure I'll be able to find. Oh, here it is. So so Marcus and Mayhem on this this chart, 22nd of October, breaking down the components of GDP by size in various economics around the world, and just kind of enlarge that. So we can see we've got this one is showing us the US, so industry, agriculture, service, and others. So industry is this orange area, and services is this blue area, which is like 80% basically. So 80% of GDP for the US is services. Now we had a Services PMI coming out, and it was let me find it again. I think it was Services PMI was down, as I said. Manufacturing PMI was also down, but services is very important. So clearly a slowdown in services is not good. A slowdown in the Eurozone as well, seems. And so this graph really shows us how important services are, not just the US, by the way. They're important to China, where we've got sort of more than 50% there is services. Japan, again, majority of GDP is based on that. Germany, again, 60+%. UK, 71%, so on par with the US, more or less. Other countries that really would be affected by a slowdown in that would be, well, all of these really, but India not as much as these other countries. South Korea has a lot of industry still. The US is quite squeezed, as is the UK. So clearly there seems to be a global reliance on industry, but obviously you can't deliver, you can't be a delivery driver if there isn't agriculture to produce the products that actually make you employable. So there seems to be a problem, I think, that agriculture is facing, as maybe heavy industry like metal works and steel and those industries. So it's a big conversation to be had, not one that I'm familiar with, but certainly reading about these things makes you aware of the complex picture of something like GDP data isn't as simple as that. And so when you look at services as a component of that, it's very important to keep an eye on that separately, or to break down, to have access to broken down data for GDP. The other thing we haven't had any news from is whether the National Bureau National Bureau of Economic, let me just find it here. So National Bureau of Economic NBER research, I believe. There we go. So I believe that they haven't released their latest assessment on the US to see whether we have a US entering a recession yet, as far as I know. Therefore, until the NBER calls a recession, there isn't one. So I doubt that's the case. If you're asking anybody who's struggling to pay their to be winter bills in US, or food, food items are getting more expensive, I think they might have a different view, obviously. But that's kind of where we're at. If we look on the news, researching the news, we might have something here about that. But I don't know if there's anything on the recession as per se, but essentially we'll have to just kind of leave it at that. So for today, just to say, this week we've got earnings coming up, as I said, Google or Alphabet, Amazon, Apple, etc. So I haven't mentioned Facebook, Metaverse, because I didn't see it listed there, but it will be there somewhere. Mostly after hours, so the impact will be felt the next day. So I would just leave it at that. In terms of price, we've come to the close of day today. We had a slight pullback there, but essentially we're in this kind of range, as I said. And so we just need to kind of hang fire and see where we're going with this. Final thought, because I was going to mention this, the VIX. So the VIX is very important. We haven't looked at it for a while, so I thought I'd give a quick update. The last time we looked at it was just around here, I seem to remember, end of September, and it was doing this double bump, and then I said it was kind of traveling higher, and we got to basically the CPI day, and it started kind of creeping lower again. It's making a little turn here, so if you hid everything except the CPI chart, what you're seeing is higher lows and higher highs up to a point, because it's kind of slightly gone below. If you made a trend line there, it would look like this. Let's do it. Trend line. Okay. Trend line will look something like, you need to connect more than 1 point, but let's do it from here. Let's say that sort of works, but I'm not sure it's a very honest one. I think a more honest one would be connecting the higher points there. That would be a more honest one. So you've got sort of one low being formed there, another one there, another one there, and this one kind of breaks below, but then rises above it again and confirms this. So you got 1, 2, 3 touches, then it breaks below. So we've broken below that, but it's the VIX, so I wouldn't really pay too much attention to putting trend lines on the VIX. You can, absolutely, why not? But it's derived from the S&P, so I mean it's not really a leading indicator. I mean, there's been lots of issues with it recently, and I basically just keep an eye on it. As I said, when it was below 20, I was kind of saying when it gets above 20, which it sort of did around here, then there's going to be so there's this drop from the middle of August. It started kind of building up, and then we're just keeping an eye on it. But essentially, I think it'll do what it'll do. You can't really do trend lines on it too much and expect miracles. When it gets to this point, which it sort of got to, but then turn back, when it gets that one again, the next one would be here. So these 13th of June, 96th of May. The next one up would be the 8th of March at 35.94. They're all pretty close to each other. There's nothing dramatic about that. You'd have to go back to the pandemic to see something in the 80s or above 50. But that's kind of where we're at. So I'm going to finish here because it's nearly 40 minutes, and hope that you managed to stay connected with some of this, and that it will be useful for you. In terms of my next video, it will be later this week, usually on a Friday. So that should be the case still, and we'll see what happens between now and Friday. Take care, and see you in my next video.